Well, it looks like we've got a lot of international events to cover this morning. I'm here with Ben Willis from Albert Fried. So one of the items we have is Merkel going to Greece. Well, that story's been playing out for, what, 3 years now, I think, and counting. Also, what's happening is tensions escalating over in Syria. Now they've got Turkey involved. It's just ramping up. And so, Ben, I would think that, obviously we saw our markets come down, but that's going to affect a much bigger picture energy, right?
Yeah, right now the currency markets are basically being driven by those macroeconomics. The IMF number being reduced this morning, the People's Bank of China changing their pumping liquidity in, had a little bit of a lift, but we're seeing that arbitrage go back and forth. But the Syrian, we've actually on the trading floor were concerned that the market had not been reacting to the artillery shells. Evidently, it took the Air Force getting involved. So that's the overriding concern right now, which has a direct impact on gold and currencies. And right now, the U.S. dollar rallying, which will help the commodities market, et cetera, et cetera. But net, it's still a very slow tape.
Let's just kind of back up to last week. I had read that 4% of the volume last week was one algorithm alone. I mean, does that concern you that so much of this market is controlled by maybe so few and by machines?
Yes, absolutely. I mean, the algorithms and high-frequency trading are broad stroke views that people need to be concerned with, but they're not all evil. They're not, and just because somebody has 4% doesn't mean that they're doing something wrong. So that has to be made clear that high-frequency trading, there are the predatory models that are designed to front run when they sense their orders that are going to move the market. But there's a great deal, most of the high frequency trading are designed just to be in the market more rapidly than other people, whether it's more of the times than not, it's to capture the spread or capture the rebate. It's not necessarily a predatory model. But yes, the fact of the matter is equities, U.S. equities in particular, are a second-class asset to U.S. citizens. Most of the buying we've been seeing for the last several months has actually been European buying. Money continues to be drawn out of U.S. mutual funds. The average investor continues to move money out. That actually is a big picture concern to me. I think the U.S. Treasury market, when the air comes out of that, I'm afraid for the world, quite frankly, about the impact that could have. Doesn't have to have, but it could have.
All right, and Ben's right. We have seen the numbers coming out on the equity side, those equity funds coming out in the billions and going over into bonds. And so they've missed a lot of this rally.
Absolutely, and that's part of the underlying, people will say, the hedge fund managers, not the average person, but the hedge fund managers, there's a great deal of money that was left on the sidelines because most of the indications were that the market should not have climbed this wall of worry. The equities should not have traded the way they traded, but the fact they did. So now, if you're running money and get paid your 2 and 20, the question is, do you sit on the sideline and wait for it to pull back to step back in, or do you need to go to work and play catch up? And I think early in the month, you may have seen some catch-up play.
All right, well, we'll keep our eye on that money because if they have that on the sideline, they're going to have to come back at some point, and they're running out of time. It's a race against the clock, and that's Ben Willis from Albert Fried.